You learned it in the 5th grade. The 3 branches of government. A perfect little triangle of checks and balances, designed by enlightened men to keep power from concentrating in any one place. It's a comforting story. It's the story we tell ourselves about who runs the country. But it's a lie. It's a lie not because it's entirely false, but because it's dangerously incomplete. There is a 4th branch, a branch that was never mentioned in the Constitution, a branch whose members are not elected and cannot be fired by the people, a branch that holds the power to create money out of thin air, to make billionaires overnight, and to wipe out the savings of an entire generation with a few keystrokes. This 4th branch doesn't pass laws, but it dictates the economic reality in which those laws operate. It doesn't command armies, but it finances the wars they fight. It doesn't sit on a high court, but its judgments have more impact on your daily life, on the price of your groceries, the interest rate on your mortgage, and the value of your retirement account than any Supreme Court decision in the last 50 years. This is the story of the Federal Reserve. And it's the story of how a private banking cartel, born in a secret meeting on a remote island, became the most powerful and least understood force in modern life. This isn't a conspiracy theory. This is the documented, acknowledged history they just don't teach you. And understanding it is no longer an academic exercise. In a world of permanent crisis and ever-accelerating change, understanding this 4th branch is a matter of financial survival. So, how did we get here? How did an institution designed to be a simple backstop for banks become the unelected, unaccountable ruler of our economic lives? To understand the monster, you have to understand the swamp it crawled out of. Before 1913, the American financial system was, well, it was the Wild West. There was no central bank. The value of money was supposedly tied to gold, but the creation of credit was a chaotic, decentralized free-for-all. And this chaos had a rhythm, a brutal, predictable rhythm. Boom and bust, panic and collapse. Every few years, a wave of fear would sweep the nation. A bank would fail, depositors would panic, and they'd rush to pull their money out. This is a bank run. And because of fractional reserve banking, the system where banks only hold a small fraction of deposits on hand, a run on one bank could cascade, bringing down the entire system. The panics of 1873, 1893, and especially 1907 were financial bloodbaths. Businesses shuttered, fortunes vanished. Ordinary people who had done nothing wrong were financially ruined. There is the story we are told, and then there is the truth. The story we are told is that the Federal Reserve was created to protect the common man from these devastating panics, to bring stability, to serve the public. The truth is that the system was working just fine for the most powerful men in the country. The chaos was profitable. They could buy up assets for pennies on the dollar after every crash. The problem for them wasn't the panics themselves. The problem was that the panics were becoming too big for even them to control. The panic of 1907 is the key. This is the origin story. The whole system seized up. Wall Street was on the brink of complete vaporization. And who stepped in to save the country? Not the president, not Congress. One man, J.P. Morgan. He literally gathered the nation's top bankers, locked them in his library, and forced them to pony up their own capital to bail out the weaker banks and stop the contagion. A private citizen acted as the nation's central bank. For the elites, this was a terrifying revelation. Not because the country almost collapsed, but because they had to risk their own fortunes to save it. They had to put their own skin in the game. J.P. Morgan and his friends realized they needed a better system. They needed a system that would institutionalize the bailout. A system that would provide a permanent, public backstop for their private profits and private risks. They needed a lender of last resort, one that could create liquidity on demand. They needed a machine. And so, in the dead of night in November 1910, a handful of the world's most powerful men took a secret train journey to a private island off the coast of Georgia, Jekyll Island. There was Senator Nelson Aldrich, a Republican political heavyweight and father-in-law to John D. Rockefeller Jr. They were senior partners from Kuhn, Loeb & Co., J.P. Morgan, and National City Bank. For a week, they hunted, they dined, and they hammered out the framework for a new American central bank. They designed the creature that would become the Federal Reserve. They sold it to the public as a decentralized system, a brilliant compromise to calm fears of a central bank controlled by Wall Street. There would be 12 regional reserve banks scattered across the country, overseeing their local members. It was a masterpiece of public relations. But the real power, the true control over the money supply, would be centralized in a board of governors in Washington, appointed by the president, but operating with near total independence. The Federal Reserve Act of 1913 was signed into law, and the fourth branch of government was born. It was created by the banks, for the banks. Its first and foremost duty was to ensure the stability of the banking system. Your stability was a distant, secondary concern. This is the core truth. It has never changed. The Fed's early years were a quiet consolidation of power, and then came its first great test, World War I. Wars are expensive. Governments rarely have the cash on hand to finance them. Traditionally, they had to raise taxes or sell bonds directly to the public, both of which are politically unpopular. But now, the US government had a new partner, the Federal Reserve. The Fed became the government's enabler. The Treasury would issue bonds to pay for the war, and the Fed would create new money out of thin air to buy those bonds, a process called monetizing the debt. It was the birth of a toxic, codependent relationship. The government could now spend without the political pain of direct taxation, and the Fed gained immense power and influence by becoming the indispensable financier of the state. It was the perfect feedback loop, the addict and the dealer. Who pays the price? You do, through the slow, silent tax of inflation, which erodes the value of your money. This pattern, established in the First World War, has defined the last century. Every major government expansion, every war, every crisis response is underwritten by the Federal Reserve's ability to create money. But the Fed's true power wasn't fully understood until its first great failure, the Great Depression. The history books are filled with arguments about what the Fed did or didn't do. Did they keep money too tight? Did they let the banks fail? Yes, they failed spectacularly. But in the corridors of power, failure is just an opportunity for a bigger budget and a greater mandate. Out of the ashes of the Depression came the Banking Act of 1935, which stripped the last vestiges of power from the regional banks and centralized it fully in the Board of Governors in Washington. The illusion of a decentralized system was over. The Fed chairman was now, for all intents and purposes, the country's economic commander-in-chief, an unelected one. And for the next 40 years, the system chugged along. But it was still constrained by one final tether to reality, gold. Under the Bretton Woods Agreement, international currencies were pegged to the US dollar, and the dollar was redeemable for gold at a fixed price of $35 an ounce. This meant there was a theoretical limit on how much money the Fed could print. Then came the 1960s, the Vietnam War, Lyndon Johnson's Great Society programs. The government was spending far more than it was taking in. Foreign countries, seeing the US printing dollars with reckless abandon, started getting nervous. They began to exchange their dollars for gold, as was their right. Gold supply began to plummet. The choice was simple. Either end the spending spree or end the promise. America chose to break its promise. On August 15, 1971, Richard Nixon appeared on television and announced he was temporarily suspending the convertibility of the dollar into gold. It was never temporary. This single act may be the most important financial event of the 20th century. It severed money from reality. The dollar was no longer backed by gold. It was backed by nothing but the full faith and credit of the United States. It became pure fiat currency. Its value was now determined entirely by decree. And the masters of that decree, the Federal Reserve. This is the moment the fourth branch came into its full, terrifying power. Unchained from gold, the Fed was now free to print as much money as it saw fit. It was no longer just a referee, it was God. It could create and destroy financial universes at will. And we saw what that power looked like just a few years later. The 1970s saw runaway inflation, a direct consequence of the spending of the 60s and the closing of the gold window. By the end of the decade, it was a national crisis. The solution came in the form of a new Fed chairman, Paul Volcker. Volcker decided to prove the Fed's independence. To kill inflation, he did the unthinkable. He jacked up interest rates to over 20%, deliberately plunging the country into a brutal recession. He crushed the unions, bankrupted farmers, and threw millions of people out of work. It was a brutal, shocking display of power. It proved that the Fed was willing to inflict immense pain on the working population to save the system for the creditor class. And it proved that the Fed could do this without any political input. The president couldn't stop him. Congress couldn't stop him. He was accountable to no one. The Volcker shock established the Fed's absolute authority. And what followed was the creation of a new, unspoken mandate. The Greenspan put. Named after Alan Greenspan, the Fed chairman who followed Volcker, the put was an implicit promise to Wall Street: if the markets ever get into trouble, don't worry. The Fed will be there to bail you out. We saw it after the 1987 stock market crash. We saw it after the bailout of the hedge fund LTCM in 1998. We saw it after the dot-com bust in 2001. Every time the market, drunk on the Fed's cheap money, stumbled and threatened to fall, the Fed would rush in, cut interest rates, and pump more liquidity into the system. This created a massive moral hazard. The gains were privatized, but the losses were socialized. Traders and banks could take massive risks, knowing that if their bets paid off, they'd get rich. If they failed, the Fed, and by extension, the American taxpayer, would eat the loss. This is the system you live in now. It is a system hardwired to protect Wall Street at the expense of everyone else. And then came 2008, the culmination of it all. Decades of cheap money had fueled an insane housing bubble. When it burst, it took the entire global financial system with it. This was the moment the Fed had supposedly been created to prevent. And its response? It wasn't to fix the system, it was to save it at any cost. This is where the mask comes off completely. Before 2008, the Fed's tools were crude but understandable. They raised or lowered the short-term interest rate. But in 2008, with rates already at zero, they needed new weapons. So they invented them. They unveiled something called quantitative easing, or QE. It sounds complex, but it's brutally simple. The Fed created trillions of dollars, digitally, out of thin air. And with that new money, they bought assets. Not just safe government bonds, but toxic, worthless mortgage-backed securities from the very banks that had caused the crisis. Think about what this means. The Federal Reserve printed money to buy the bad debt off the balance sheets of the largest banks in the world. It was the biggest bailout in human history. They didn't just become the lender of last resort, they became the buyer of last resort. They became the market itself. And what did this do to you? This flood of new money had to go somewhere. It didn't go into your paycheck, it went into financial assets. The stock market soared. Real estate in major cities rocketed back up. The rich, who own the vast majority of these assets, got richer than ever before. The wealth gap, which had been widening for decades, exploded. Meanwhile, for ordinary people, wages stagnated. The cost of living, especially for housing and education, went through the roof. Your struggle to afford a home, your feeling of being left behind, the sense that the system is rigged. It's not a feeling. It's the direct mathematical consequence of the Fed's actions since 2008. They chose to save the assets of the wealthy at the cost of devaluing your labor and your savings. And if you thought 2008 was the endgame, you weren't paying attention. The pandemic in 2020 was 2008 on steroids. The economy shut down and the Fed went nuclear. They dropped interest rates to zero. They launched unlimited QE. They didn't just buy bad mortgage debt. They started buying corporate bonds, even junk bonds, directly propping up massive failing companies. They crossed every remaining red line. The fourth branch of government effectively merged with Wall Street, becoming a single, monolithic entity that backstops everything. Today, the Federal Reserve is the central planner of the entire economy. Its chairman is more powerful than the president. His every word is passed by markets for clues about the future flow of free money. He can decide which industries live and which die. He controls the price of money itself, which is the price of everything. And you have absolutely no say in any of it. So we arrive at the central, uncomfortable truth, the core lesson of this entire story. The game is rigged. You were taught to work hard, save your money, and invest for the long term in a diversified portfolio. That advice was designed for a world that no longer exists. It was designed for a world where money was a stable store of value. We no longer live in that world. We live in a world where the central bank's primary mission is to devalue its own currency, to service debt, and to bail out a broken financial system. Saving money in a system designed to create inflation is like trying to build a sandcastle against a rising tide. You are guaranteed to lose. So what is the answer? The answer is not to descend into despair. The answer is not to buy into some wild conspiracy. The answer is to see the machine for what it is, to accept the rules of the new game, even if you hate them. Fighting the Fed is a fool's errand. Understanding the Fed is the only path to survival. You must understand that when they print trillions of dollars, that money flows into hard assets. It flows into real estate, into dominant tech companies, into commodities, into things that cannot be created with a keystroke. You must stop thinking like a saver and start thinking like an owner. You have to learn about inflation, about monetary policy, about the difference between real assets and paper promises. The financial education they never gave you in school is now the most important education you can get. This channel, and others like it, are a starting point, not an end point. The three branches of government may rule the nation, but the fourth branch rules them. It controls the money. And in the world we live in, the one who controls the money controls everything. Your job is no longer just to earn it and save it. Your job is to protect it from the very people who have the power to print it. And that battle starts with understanding the truth.